Joining me in studio, Tom White has been looking through some trading options, looking through the numbers.
Yeah.
Disney had a big pop. Let's start with the chart. It's the best place to go. Okay, here's the short-term move. It's climbing over the past 5 days. If you look over the year, the big majority of its rally came in the span of like a single day. Then it added on top of it, and it's been fading since.
It has, and a lot of that has to do with the coronavirus fears. They closed their Shanghai resort. Remember, the parks make up about 40% of their revenue. And I think a lot of people forget about that. But I think the key number that we're going to have to take a look at for these results after the bell today are going to be subscribers for the Disney Plus.
Okay.
Estimates are about 20 million signed up during the quarter. You got to remember, this just started in November 1st. They've already gotten about 20 million subscribers. Anything north of about 24, 25 million on the subscriber number, we're probably going to see a pop in the shares. But they do have some headwinds also, Oliver. They've got mixed results in some of their new releases as far as movies go.
Okay.
You do have the coronavirus fears, so maybe their park revenue will be a little bit lighter.
Park revenue could be light in China. That's been an important part of their expansion. But on the other hand, people are maybe sitting inside streaming Mandalorian nonstop.
Yeah, but Mandalorian's ended. Stocks are forward looking. So
you don't rewatch shows, Tom?
Yeah, no.
Okay.
So, but if you take a look at that, we've also seen a downturn in their subscriber growth as far as ESPN that kind of bottomed out in 2019 as far as losses there. But now you're starting to see some metrics that are reflective of a decrease or a potential decrease in some of their networks, the ABCs and ESPN.
That's known, right?
Yeah.
These are the known issues. I think the number here that you point out, which is, remind me, what are we looking here for subscribers? Because Apple kind of dropped a little bit of an egg.
Anything below 20 million is going to be a surprise to the street. Now, a lot of the estimates are for above 25 million.
Right.
Those slowly went up because those first couple weeks when they launched Disney Plus, the subscriber growth on a daily basis was pretty substantial. So they most likely will beat on that subscriber number, but anything above, like I said, 24, 25 million is probably going to be a positive for the stock, and they might overlook some of these fears as far as coronavirus, but maybe Disney's in that sweet spot. Implied volatility, according to the option market, is at or near 52-week highs, and which you'd expect going into an earnings report, higher volatility, but also the pullback that we've seen in the shares over the last week and a half since this coronavirus, the fears started ramping up.
All right, shares at $143 right now. A nice little bounce here over the last couple of days coming into this. Again, Apple's numbers for their subscribers, I think we're a little bit weak compared to obviously Netflix and Disney too, because Disney just overnight became such a competitor in this realm.
Right.
And I think that's what's pretty impressive about it. For the most part, apart from like a few initial minor glitches the first day, this has been a smooth, impressive rollout by Bob Iger.
Well, you got to look at what they have, and what they have the most of out of all these players is content. They've got content that they've been curating for years and years and years, and for them to have that ability to pull back shows from some of the other streaming services and also put that content into play, whether your kids are watching cartoons, Disney cartoons that came out, or people that watch all the Avengers movies and the Marvel movies, and then you've got Star Wars in there too. So they've got this cachet of content that is above and beyond what anybody else has out there right now.
Yeah.
And that's why you're seeing them take a little bit of share. And you look at that price point, Oliver, for Disney Plus. It's comparable to a lot of the new ones that are starting up, but far below what Netflix is offering. And that content spend that Netflix is, everybody keeps talking about, Disney doesn't have as much as that because they've already got that library of content that they can rely on to grasp those new subscribers.
All right. So now we'll watch to see what they say about consumer activity in China. Let's talk some trading here.
Yeah.
All right. Let's say you want to get long going into this thing, that it's due for some extra pop.
Yeah.
What do you think?
Well, volatility is elevated. If you're going to get long, I'd probably sell a put vertical. But what I came up with was taking advantage of that higher implied volatility, something more neutral in stance to take advantage of the increased option premium that we're seeing in the overall market, because
Right.
I think there's going to be numbers that are good and numbers that are going to be bad for Disney. Maybe it stays neutral and you take advantage of that.
It's like a net
volatility.
mixed report, and you want to trade it within a range.
Yep. The option market's pricing in a plus or minus about $6.5 move in this.
Okay.
That's roughly or 6.5% move,
Okay.
about $8
Yeah.
right now. So I just looked at the first one. I looked at a double diagonal, and this is a straight double calendar. It's only 2 weeks wide. You buy the February monthly series that expires in 17 days. You sell the near-term Feb 7th weeklies that expire in 3 days. Now, you do the 152 call calendar, the 136 put calendar. It's 2 weeks wide as far as duration goes, so really inexpensive at about a 90-cent debit. And you can see right there, Oliver, this is playing for a move in Disney, about that expected move of about $8 either way. You've got the 152.5s on the upside, 136s on the downside. So basically what you need on this, you don't want it to remain around 143. That's going to probably be worst case scenario, unless it goes up or down more than that one standard deviation. That's when you've got that 90-cent debit, which is a risk on it. So you want that, you want to play that for that move in the stock, plus or minus. You do not have to pick a direction on this. And what this takes advantage of is that volatility is going to get crushed in your short options. You'll be able to roll those to the next weekly series, garner some more credits, increase potential profitability on that type of trade. But this is basically a neutral trade where you want it to move.
Yeah.
You want it to move that one standard deviation move that the option market's pricing in with that higher volatility.
Okay, but you've got another one here you could do, an iron condor that's also range bound, but the main difference here is what?
You're actually taking a credit on this, so you actually want it to remain around 143.
Right.
But
this one, you've got a range that's much closer to where it's trading right now.
Right.
The other one, you can get a swing, and you're getting paid.
You want to swing.
Yeah, you need a swing.
This one just takes advantage of it not moving that $8 either way.
Okay.
And it remains in a range here, but you've got a nice wide range. I sold the 152.5, 155 call vertical to the upside, taking advantage of that higher elevated volatility, then selling the 138, 135 put vertical. The put vertical is $3 wide, call vertical is $2.5 wide. You're collecting roughly about $1.30 credit on that. You see the break evens there, Oliver, down to 136.70 and 153.80 on the upside. So you take advantage of that higher implied volatility. Now, what happens tomorrow if Disney opens up around 145, 144, 140? Volatility is going to get crushed because the earnings event is already out, right? And time decay works in your favor. This is about a 17-day trade because you're doing the monthlies, so you still have about 2 weeks. In case the stock moves really far up or really far down, you have some time for it to consolidate back towards that 143 midpoint. But the key thing is you've got a nice range in this, and the higher elevated volatility allows you to collect $1.30 credit. On the risk side, you've only got a $1.20 risk on the upside, a little bit less because it's only $2.5 wide. But on the downside, you've got about $1.70 in risk, so a little bit more. So it's nearly 1-to-1 on the upside, a little bit worse on the downside, but you're playing for that range, for the stock to trade within that specific range, and you'll get volatility to get crushed. You can buy this back cheaper to exit it, or let it go out worthless at expiration in 17 days. That's the most profitable way.
Right, you just want to let it ride out.
But if it gets down to trading 40, 50 cents, maybe you buy half of your position back or all of it, and then take any risk off and move on to your next trade.
Point here is the distinguishing factor between the two is whether or not you think Disney's going to have a big move on the earnings. All right, well, we'll find out this afternoon on Market and Close. Thanks, Tom White.